Welcome back to the channel, guys. I hope you're having a fantastic day wherever you are around this beautiful planet of ours. Today, let's look at accumulation, crypto breakouts, Bitcoin traps, and of course the old, is the Bitcoin bottom in? Now, there is some really good evidence that we may see a bottom, but of course, if you've been subscribed to the channel for some time, you know exactly where we're up to, and this is building upon the previous videos of the channel as well. So make sure you have subscribed with the bell notification icon turned on, like the content up so that you can see this in your news feed. But if you're unsure and you want to wait till the end of the video, I'll remind you again then, don't worry. All right, so the first thing I want to have a look at is the market psychology around the Bitcoin bottom being in, and then obviously look at the facts around how bottoms are formed. If you've been around in crypto for just a few weeks, you would have seen some sort of tweets like this. The Bitcoin bottom is in, rocket ships, capital letters, shit just plastered all over our Twitter feeds. This sort of thing really gets a lot of people psyched, especially if you're new to the market, because when you're new, you're basically looking for confidence, someone that knows exactly what is going on. But the truth of the matter is, no one knows exactly what is going on in the market. No one has that crystal ball. All we work from for investing and trading, one's just a shorter time frame to the other, trading is shorter than investing, is just the probabilities of what we think is going to happen next based on the facts that we are reading in the charts. So of course we use certain types of analysis. In this case, we use a lot of technical analysis. And the person who came up with the analysis that I like to use is W.D. Gann and Richard Wyckoff. So two guys from the early 1900s, both have now passed, but their analysis has been tried and tested for over 100 years, which is why I love to use their analysis. It works in all markets, cryptocurrency, stocks, anything with a chart, Forex. It works on those markets because of simple fundamentals within markets themselves. So could the bottom actually be in? Well, if we ask content marketing, they're pretty sure of themselves. The bottom is in. This is how the Dunning-Kruger effect works in content marketing. Basically, the experience level here is from 0 to 100%. Usually, not much experience is very confident in what they say. And then you go through this process of learning about the market or whatever topic that you're interested in, and you start to feel far less confident. So if you are feeling less confident in the market from your own analysis, it's possible that you're going through an experience growth in that field. And the guys who are shouting that the bottoms are in and that they're extremely confident may not be going to that end of the expert level, or they're just really pumping out content marketing for obvious reasons in their own business. So I just want to lay that groundwork first, because there could be bottoms in, and if the bottom is in and the market goes up from that point, then the people who've been shouting the loudest tend to look the most brilliant come the other end. But of course, there can be traps in the market as well. So the next thing I want to look at is the Wyckoff accumulation and how this is playing out on the chart itself, just in a broader term macro look here on the weekly chart. So the accumulation, the Wyckoff event, we've had the selling climax. So it's possible that we've had that selling climax, and we do have multiple areas of accumulation and potentially redistribution. And you don't know until there is a breakout of that particular trend. So like we can see here on the schematic, so accumulation, the Wyckoff event, you don't know if it's an accumulation until after the fact that the trading range, which are these levels here, these horizontal lines, has been broken out of. There's confirmation of that break and the market goes on. So while we're still in this zone of the market here, basically trading between 17 and approximately $25,000, $26,000, this could be another redistribution before the market heads lower, or it could be accumulation. That doesn't help anyone. I understand. I know that we want to know if the bottom is in. So what we do as investors or traders, depending on which time frame you're working on, is look at the risk to the downside and the reward to the upside. So at the tops, there is a lot more downside risk compared to the upside reward. That's why when we get to higher prices, people are getting really excited about things. It's much easier if you've been in the market long enough to say, I think this is getting a little bit scary because everyone's saying it needs to go higher. Whereas when we're at lower prices, the risk to the downside is a lot less. So if you've been in the market now and you're still hanging around while the volume is dropping off and everyone is leaving, then I'm sure you've heard that multiple times already. So looking at the accumulation, let's have a look at something a little bit deeper on the pattern, and then of course look at the trap as well. So if we are in this accumulation phase, looking at phase A, we'll have a selling climax, which is the SC, and that is marked by widening spread. Do we see a widening spread? Yes, on a weekly chart here, we can see big volume to the big volume and also a big range to the downside. We see selling pressure, climaxes, heavy or panicky selling by the public is absorbed by larger professional interests at or near a bottom. So at or near a bottom. Often price will close well off the low in a selling climax, reflecting the buying by these large interests. So there's the low at 17.5, and then it closed at 20.5. So although I wouldn't say that that is far off the low, it's still not at the low. So that's a good sign that at least the bottom was trying to come in. And then over the next several weeks, the market wasn't able to break past that point. But this is where the exciting part comes in, because now we've had an upside test, and what Wyckoff calls it is an AR over here, so an automatic rally. You get a bounce out of that selling climax. And then we're looking for an ST, a secondary test. So if this is the secondary test that we've just been through, that we're experiencing right now, this should look like a test which price revisits the area of the selling climax to test the supply-demand balance at these levels. If a bottom is to be confirmed, volume and price spread should be significantly diminished as the market approaches support in the area of the selling climax. So have we seen the volume and the price spread be significantly diminished? Well, at least a week, which was yesterday, finished up a day or so ago, that definitely is a very much diminished price range. The volume overall has diminished over time. That's what we want to see, especially if this is potentially one of the final redistribution zones or the major accumulation zone, the beginning of the major accumulation zone. That's what we want to see. So the secondary test is looking pretty reasonable now. So does that mean that we are about to shoot off to new all-time highs if we're to get another push up? Well, according to the accumulation schematic, probably not. We still have to go through a phase B, a phase C, a phase D, and then finally a breakout for phase E. So this is where we can get trapped again, this whole phase B where the market hits that secondary test. We're potentially in that now, and then we get that pump up to test the automatic rally price. So as we enter into phase B, we do have to come up and test the automatic rally, which is this top price here. And it's looking like this will end up being a resistance line, which forms part of the trading range. So you'll have multiple trading ranges here, the upper and the lower, and then obviously the next lower here, so some support lines. And then this shows where the next secondary test, the springtime, the next test, and then the last point of supply will start to come in. But if this is the case, I know there's a lot of ifs, because like we go back to the old Dunning-Kruger effect here, we don't know for sure. If we're 100% confident of something, that usually means we don't know what we're talking about. Or you could argue I don't know what I'm talking about whatsoever. But if we go with what the Wyckoff Accumulation is saying here, then it looks like we have a fair bit of time. But in the meantime, this could lead to that potential trap. So what does that look like on the Bitcoin chart? For me, the trap looks like any sort of price movement that comes up really quickly and starts to break past some of the previous resistance levels. The first being this top here, the AR, which is what we just looked at here, the automatic rally from that June low. So that's at 25.2. Then our bullish Wyckoff flip, that was at 26.9. So if these levels are taken out rather quickly, then I would say that we are just going on a low volume, that low volatility pump to test the upside, and then we'll probably see the market fade back down, which still means that this could be the low. But of course, we need multiple phases of this accumulation to play out before we then break out, and the final low is actually confirmed many months away from where we currently are. So I might even post something like this on Twitter, which I won't. I can't do that to myself, and I can't do that to you guys. But if that is the case, then it's easy to show this down the track saying, well, look, I called the bottom, but really there is no way of knowing for sure that that is the bottom until after the fact. Diving a little deeper on the trap can look something like what we saw in the last cycle in 2019. And we had the accumulation zone here, we had the market start to break out rather quickly and then peak into a top just a few months later. Went sideways, everyone was waiting for that next pump up to take out 20K, But of course, what do we get? We get the market just start to fade out because it wasn't ready yet. The timing wasn't there. And we've looked at timing a lot going back on the channel. I'll leave a link to these playlists at the end of this video, especially the September forecast. Remember, we are looking for another bottom. It doesn't mean it has to be a lower low than 17.5. It just means potentially something else significant coming later in this year, whether it's October, November, December. I think there's something else significant coming. Just like this one here took another 12 or so months. You had something in March. There was even a bottom here in December of 2019. That's still another significant low in the move before it takes off to the next bull market. So you had the low in December 18, you had another significant low in December 19, you had that previous peak in December 2017. So there are a lot of turns happening approximately 12 months apart. And so this thing, in my experience, just doesn't run straight out of here. Of course, I can always be wrong. I'm not going to sucker myself into this saying that I know for sure. I can always be wrong, and we'll know that, and we'll be able to flip our understanding and start to manage our risk and reward if we start to see those signs of more bullishness coming and less downside happening. So the trap, once again, is basically if we run up really hard, not to get suckered into the FOMO. I know it's a repeating topic here, but that is really one of the biggest things that loses people a lot of money because it's lost in time. We get suckered into these runs, so you end up buying the top and then you hold out waiting for the price to go higher, only see it to fall down a little bit further, and then you think, man, I'm just going to sell out here because it's going to keep going down. Before you know it, you've sold out and the price just starts to creep back up without you. So there's a lot of money lost in chasing those FOMO pumps. If you find yourself getting caught in those FOMO pumps, one thing that we do tell our members over at the Investor Accelerator, and if you want to join our free newsletter to get another feel about what we talk about in terms of Bitcoin, real estate, and the stock market for our own investment portfolios, check the link out in the top of the video description. Free investor newsletter comes out once every 2 weeks, so you're not getting spammed and you can get another feel for how we manage our positions in the market. But essentially what we tell our members is manage your money and your position sizing at these points in time. If you think you're going to be sucked into the FOMO with the run to the upside, maybe throw a little bit of that position into the market now so that you can feel like you've got yourself set, so that when you do see the market run away, you don't end up throwing a lot of your cash in at the top only to see the market fall back against you. So little things to try and hack your own investor psychology, and of course keep a journal, write these trades down, and then reflect on what you've done in the market going forward from this point. Look back several weeks, see what you were feeling and what you actually did so that you can improve on it moving forward. So is the Bitcoin bottom in? Honestly, of course, I don't know. I don't think anyone else knows. Now, there is a difference between a calculated estimation that it is possible the low is in based on previous data and facts that are in the charts, and the difference obviously being someone who just calls the bottom every single time the market falls. I think those are two very different things. And even the person who has got a lot of calculations will tend to say, we're not sure, but the probabilities are weighing in the favor that this is potentially the bottom rather than there being potential further downside. We've covered a ton in today's video, especially around accumulation, what it is, why it happens. Are we seeing the Bitcoin bottom? And of course, the market expectations around FOMO and what to expect in case there is a trap. So if you haven't already and you want to join the journey here in terms of learning about investing, smash up the subscribe button with the bell notification icon. Of course, like the videos and join us over at the Investor Accelerator. Check out the free newsletter, link in the top of the video description. I'll see you guys at the next video. Until then, have more fun to get more done. Peace out.